Labrīt, good morning, and welcome to Swedbank Economic Forum in Riga. It's so good to see you all here, as well as watching us online. This meeting is one of our annual traditions that brings us together with our clients. That's why we are cherishing the opportunity to this year also host the event in person, as last 2 years we were interrupted by pandemics and had to resort to online-only mode of the meeting. And who would knew then the situation that we are finding ourselves today, whereby while COVID is still around us and has not disappeared, we have been hit by the new shocks that has left everyone wondering and pondering about the short-term and long-term effects, amongst others, on the global order, economic development, and outlook for many industries. In the situation we are finding ourselves, and in this space of events, we are finding ourselves with more questions than answers. And sometimes even kind of getting used to these recurring shocks coming our way, where we desperately actually seek for silver lining in yet another batch of troubling news or concerning forecasts coming our way. But then, nevertheless, some things have become clearer. The climate change and the now geopolitics have put all us on the transformation path. The investment-intensive transformation path that is gaining momentum by every day. And the transformation can be achieved only by a joint and collective effort. And today, in this room, and also our clients watching, are a big part of those that are part of this collective effort and that are important enablers of this transformation. We have you, our clients, the businesses, that we know have resolve, expertise, and ability to make decisions, bold strategic decisions that are affecting long-term growth possibilities also during the times of increased uncertainty. We have expertise and we have views on the risks and underlying opportunities that exist for us going forward. And Arius and his colleagues will sure share many of those insights with you today. And we have our bank that today stands as strong as ever and as committed as ever to help our clients and economy to fulfill those fundamental opportunities that exist along this transformation path. So it boils down to that together we are better suited to achieve this common ambition. And if anything, then that is a reason for optimism. So on that note, I would like to wish you an informative, interesting, and hopefully also inspiring day. And without any further ado, I will hand over to Nerijus as a ceremony master for today. Thank you.
Thank you, Lauris. Thank you. Oh, we can keep it here. My name is Nerijus Mačiulis. I'm Chief Economist at Swedbank Lithuania. And as you know, economies move in cycles. And for me, this is a bit of a déjà vu. I joined Swedbank exactly 12 years ago. And back then, Europe was in a large crisis. You may remember that. Euro area debt crisis, Greece on the brink of the bankruptcy, Greece, Portugal, Ireland, Spain needing bailouts. A lot of uncertainty, discussing the future of the euro area. Is it going to break up or not? And then, in the midst of that crisis, oil price goes up and ECB starts increasing interest rates. Just as the euro area is recovering after the global financial crisis. And not unexpectedly, euro area enters another recession in less than 3 years. We see something similar today. Europe is in crisis, obviously. First of all, due to the energy markets and due to the crisis in the energy sector. And we also see increasing interest rates. But at the same time, it's also a bit different. So as Lauri said, we all have a lot of questions. Rest assured, we also have a lot of questions, but hopefully we also have some answers for you today. And I think we have 6 very good presentations on the developments that take around us in the world and in our local economies. And these presentations will be followed by questions, your questions and our answers. You can ask these questions on Slido. I suppose you will see the information on how to post these questions, and they will be directed to the speakers here in the audience. And those who are here live, not following us online, will be able to ask the questions also live in your preferred language. So without further ado, I ask our Swedbank Group Chief Economist, Matthias, to join me on stage and tell us what you think. What is happening around the world? Should we be very afraid or not so much?
Well, thank you very much, Nerijus. And it's great to be here in Latvia. It's really good. Unfortunately, I think the message that we will communicate today, I don't think you will be surprised, but it is quite a gloomy outlook that we have. And it will be worse before it gets better. I will talk about the bigger picture, the global economy. I will talk a bit about the ECB, the euro area, the US. But I think more or less which country I were to talk about, the outlook is pretty much the same. There are differences, and I will highlight some of that. I'll just try to keep the time. So, this doesn't work. Can you please? Okay. So what has happened when we think about the global economy over the last 3 years? So all of us know, and all of us have lived through enormous shocks to the global economy. That has impacted our lives. I think it's fantastic that we can meet here today, because of course the first shock that hit us was pandemic. And the pandemic brought with them supply chain constraints, a lot of protectionism in the early stages of that, and all of us were working from home, more or less. Some of us still do that. But there were profound changes, I think, in how the global economy works. When I meet corporates in Sweden, many of our customers, they are changing the way they operate as a consequence of the pandemic. So they are being more regional in their operations, they're moving back some operations to Sweden, and they are changing how they operate supply chains. Then all of us suddenly are wizards on having Teams meetings and how to operate out of office. And I think there's a lot of positive impact on that, but that also means that consumption patterns are changing. But the underlying pressure from the pandemic has been supply chain and high demand for certain goods, in particular IT and things like that we needed from working home. So it's not only about supply side, there were also high demand for various parts of the global economy. Not so much services, because we were working home. So for economists, this is an inflationary impulse to the global economy. We saw a lot of scarcity. All of us have heard about semiconductors, the problem of that. Supply chains, how that impacted corporates. Couldn't finalize the products because they were waiting for a small part of the item to be delivered. So costs were going up, inflation were going up, in particular producer prices, because China also closed down. But we were coming out of that earlier this year. And we were feeling optimistic about the outlook. Then everything changed overnight. And that was when Putin invaded Ukraine. That again was a massive shock to global economy, in particular European economy. It's close to all of us, and it was unthinkable for us to think about a war in Europe. just a year ago. That is also a supply chain or supply shock to the economy. And again, we have one clear impulse, and that is prices up. The most obvious one, Neerjus already highlighted, and we will discuss that more, and that's energy. So in all of those two massive shocks that have hit the global economy over the last 3 years, all of them has one clear indication, that is prices up, inflation up. Not only because supply chains problems or lockdowns in China, but also high demand still. So, and this will impact and are impacting both of those shocks where we are today, and how the outlook is impacted by those shocks. So when we look forward now, having lived through pandemics, and we are still having a war in Europe, an energy crisis that we will talk much more about, we see a completely different development in the global economy. A much darker outlook, but we only expect, at least for now, that next year it will be a lost year. A lost year, not a catastrophe so far. But we are going to feel the pain over winter and early next year. So we think that the global economy will stagnate more or less. We have revised our outlook for global economy from 3.5% to 2%, so that's not stagnation. But in many parts of the world, we will have stagnation. That is very, very low, if any, growth. That is true for the Baltics, more or less. That's true for Europe, and it's more or less true for Sweden as well. So all our home markets, we will see stagnation. We also expect the US to more or less stagnate, and that will start during the winter, according to our forecast. And what's driving this are different drivers. I've already talked about inflation, and inflation is at historically high levels. We need to go far back in history. 15 minutes ago, we got a Swedish inflation print today. And again, it was on the high side. It was actually lower than our expectations, but higher than markets. So inflation at 9%. 9% is not as much as 25% in Estonia or 22% in Lithuania. But it's high. And it's the same in the US. We had an inflation print yesterday in the US, which took markets by surprise. Inflation ended up higher, and in particular core inflation ended up higher than markets anticipated. So we will see a cost shock to corporates, to households. We will see disposable income developing very, very badly. In Europe, we think that the energy crisis will worsen. We have already seen that to a large extent. And the downside risks are larger than the upside risk, much larger. And it is all about inflation, the war in Ukraine, and energy. And also China, that Glenn will talk about a bit later. I actually think that the slowdown in China is good for us. It's good for Western economies. And the reason for that is that the inflationary impulse to the West will be less. The bad thing is that when the world's second largest economy doesn't grow that much, that means that the world will not grow that much. So inflation is way too high. Central banks, and I would argue more or less all central banks, are behind the curve. They did not take away the punch bowl in time. And inflation is running too hot, which means that they have a lot to do during winter. The problem that I see with that, for all central banks, that I see a risk, and we highlight that in our latest forecast, that the risk of a policy mistake, that central banks increase policy rates too high, too much, too fast, is quite large. And if that is to happen, then we will not have a soft landing. Then I think we're going to have a hard landing. And what that means is even lower growth and a longer economic downturn. And I think that's true for the ECB, it's true for the Fed, it's true for the Riksbank. All of them are behind the curve. Even Norges Bank, I think, but maybe not as much as Riksbank. And this is a problem, because it's also a political problem. And all of us, we need to trust in our central banks and the inflation targets. Otherwise, expectations will not be well anchored. We will get even higher salary requirements, and you already have quite high wage increases in the Baltics, in particular compared to Sweden. So I think that's a risk. Let's talk a bit about the euro area. Nerijus already said that it's a gloomy outlook, and it's more or less all about energy. So to the left you see the stock of gas, natural gas, and you know a lot about that here in the Baltics, because you're also building an LNG terminal, and you have an LNG terminal, and you have also some reliance on natural gas. And you can look at the future prices for electricity in Europe, and it doesn't look good. And if you follow media, you think that Germany is the worst in Europe, and that's not the case. It's actually France, which is the yellow one to the right. So according to market, energy prices will be much higher going forward. And the problem is, it's not only about Russia and natural gas, it's also about nuclear. So in France, all the nuclear reactors are not operating. In Sweden, Ringhals, another nuclear reactor, that start has now been delayed even further. All of that means energy prices will go up. I think it's going to be a tough winter for Europe. The only positive sign I see and hope is EU Commission, which is an odd thing to do, that hope that the EU Commission will deliver. But I think that they are really pushed against the wall. They need to deliver on the electricity market. For me, the best thing is a revenue cap for all producers that don't produce gas or use gas, so you don't distort prices, and then distribute that back to consumers, corporates and households. The reason why I like revenue cap is because it keeps the market as it is. You keep the markets to clear, you keep investments going to renewables, and you will see investors keeping to invest in renewables and energy in Europe, rather than distorting prices with caps. So for economists, prices is everything. We need prices to sign where we have scarcity. That will help us to invest and solve the problem for the future. But regardless of what, Europe will have a really, really tough times. You can't really see that when ECB hikes, dramatically. In our forecast, we will see stagnation in Germany, actually a bit worse. GDP growth next year, according to our forecast, is minus 0.5 for Germany. Stagnation in France, in Italy. It is a tough time coming. And at the same time, we have high inflation. So I think for ECB, the problem with high inflation is here to stay. And the problem I have, and I think many of my colleagues have, is to really understand the reaction function of the ECB. Because they are behind the curve, there is political pressure on the ECB, they have already hiked, and they need to hike more. The problem is, will they do a policy mistake and drive economic downturn even deeper? I think, unfortunately, they need to do that. Even though inflation in Europe is much more energy-driven than it is in the US. In the US, it's much more fiscal policy that has generated inflation. And that's not the case in Europe. And we have already seen a lot of packages from Germany and many other countries to shelter and support households and corporates. But I think we need to do more, in particular on an EU-wide scale. I think the EU Commission needs to deliver something credible on that. So Europe will slow down. ECB will continue to hike, but I don't think they will hike as much as markets are expecting right now. So let's then turn to the US. As I said yesterday, that there was CPI coming out yesterday in the US, came in at 8.3 and underlying core inflation at 6.3, higher than market's expectations. Here the problem is not so much about energy, because expectations was that inflation was coming down in the US because of gasoline prices coming down. But inflation print was much higher. You could see equity markets falling dramatically last afternoon due to the Fed and the market reaction to that. The problem for the Fed is much more difficult, because it's not the supply side shock, it is driven by fiscal policy and what they did during the pandemic, sending out checks. That was a good thing at that time, but it went directly to consumption, which meant that we have a lot of inflation to catch up for the Fed. And in my view, the Fed needs to kill the labor market. Wages are increasing. There are 2 open positions for every unemployed. The labor market is too tight. And if you think about a central bank that needs to tighten so much that you need to kill the labor market, it's not going to be a soft landing, I think. I think the risk of a hard landing is much higher today than it was just before the inflation print yesterday. So also here, I think this is not good for the global economy. But it's not as bad as the energy crisis in Europe. So Fed will continue to hike. We will probably see the housing market in the US, which hasn't really fallen yet, will start to fall as well. We see that in Sweden already. House prices are coming down, and we expect that to continue. I would expect the same for the US. The supply of unsold houses are growing rapidly in the US. And inflation is much broader and much more wage-driven than anything else. So it is a different and difficult task. Now this is not updated after the CPI print yesterday. And markets are now expecting even higher policy rate than actually printed here. So market expectations is the violet one, or purple. And market, before the print yesterday, expected that the Fed were going to lower policy rate next year. I don't think that's going to happen. And it has not been in our forecast either. I think the inflation is so high for all central banks that it will take some time for them to actually lower policy rates. It's much more persistent inflation, even if it's more energy-driven in Europe and here in the Baltics. So there is much more to be done from the Fed. They will continue to hike. So next meeting we have in our forecast 75 basis point hike. When I read what's being discussed now, it's maybe that they need to increase the policy rate in the US with 1 percentage point. When you think about it, it's quite a lot. But monetary transmission in the US is not as quick as, for example, in Sweden. In Sweden, monetary policy is much quicker because of our mortgages that we have. So I think it's going to be a difficult period. But there will be winners. Not all sectors in the corporate sector will be impacted in the same way. Some sectors can actually benefit from the situation we are in. And that's particular sectors which, of course, energy producer is a given, because, you know, energy prices is at heaven. But also forestry, because it's a hedge against the inflation. Maybe agriculture. Also production firms that don't is energy efficient, and defense, obvious winners in this cycle where we are. So I will not go through all our GDP numbers. It's just to say that it is 3 weeks more or less since we released our latest forecast. We have already revised some of our forecasts to the worse. We have increased our inflation forecast. We have increased our views on the central banks, how much tightening that they need to do. And that has implications for us going forward. But at best, and we are still a bit optimistic that maybe it will only be next year who will be a lost year. where we will lose in purchasing power. We will feel it in our wallets because inflation will be high. We will not be compensated through wages. And actually, I think that's good. Otherwise, I think we could end up in a very vicious circle if wages increase even more, prices increase more. That would not be good. So I think I'll stop there. More or less right on time.
Thank you, Matthias. It's a bit gloomier than what we usually are. Economics is a dismal science. But it's a good thing that you mentioned that there are also winners in this cycle. So clearly agriculture and some commodity producers and forests and defense, you can find and identify sectors and companies that are not going to be suffering. And those companies that have invested in renewable energy and produce their own electricity, I mean, they're really in a very nice competitive position today. So thank you, Matthias. We'll have some questions from audience, I suppose. I have some questions, but we'll get them after all three presentations that we have now. And as you have seen, probably at the core of this gloomy, chilly environment that we have is prices. Prices of everything. We've seen inflation that we have not seen in 4 decades in US, in Euro area. We have not seen a quarter century in Baltic countries. Prices of energy. Then prices of money. Interest rates are increasing. And that's, I could say, for a lot of people, a relatively new phenomenon. We have a new generation of people who took out mortgages, who borrowed, and they knew that Euribor is equal to 0. And I can tell you the biggest amount of emails that I got during the past few weeks is asking me, why did we, as the bank, increase the Euribor to the good clients who have been paying on time and so on. So not all people know that Euribor interbank interest rates is not set by any given bank. It is set by the central bank that determines the base price of money. What I'm driving to is that we have been living in a decade of a very, very low or even negative interest rate environment, which has changed the way people think about borrowing, which has had a lot of implication on asset prices. So the third one is also asset prices. How this crisis, how this inflation and these increasing interest rates may affect equity prices, real estate prices. That's another, I think, relevant question to all of us. And for that purpose, I give you a toughest question and toughest topic. Our chief economist in Norway, Kjetil, please join me on stage and enlighten us.
Thank you very much.
When will the prices stop going up? And when will the interest rates stop going up? And when will the equity prices start going up again?
If I had those answers, I would probably not be here, right? But thank you very much for a nice introduction, Arius, and good morning from my side as well. I guess your story was really pointed to me. I'm one of that generation, not really used to seeing higher interest rates, really. But one anecdote from, I come from Norway, and the central bank governor in Norway is also head of the pension fund, so both a central banker and an investor. And the former governor was asked before he ended his tenure late last year how he would cope with high inflation. And his answer was, being a central banker, that's really easy. Being an investor is tremendously hard. And I think that's what's kind of played out this year as well, seeing interest rates increasing massively and asset prices dropping quite fast. So Matthias has touched upon a lot of current issues, current topics. What we're seeing across the globe, this is not only a kind of Western phenomenon. You see it in other areas of the globe as well, central banks being behind the curve. A lot of supply shocks, of course, and supply shocks often has a tendency to deteriorate the economy when it's increasing inflation. And central banks as a whole cannot really control rather energy prices or pandemic effects, supply chains. But there are some important channels we need to look at in order for understanding the central bank reaction functions. The first one is certainly the FX or the currency channel. Certainly, central banks cannot do anything about global price increases, but they can kind of soften or soothing the implications for the local economy through the currency. So a stronger currency certainly helps reducing imported inflation. Now, the currency market is kind of a zero-sum game. So you end up in a slight currency war between central banks. And that's becoming perhaps increasingly important as well when you see other issues with inflation. Certainly labor markets demanding pay rises, so that's also a very important channel. Now, labor markets are, in general, I would say, without being too specific, quite tight. So it's tighter most places than before the pandemic. Even in Europe, although wages have yet to start increase, if you look at the euro area as a whole. Matthias mentioned the US, you could also point to the UK, for instance, where you see markedly more tight labor market today than before the pandemic. So that's one of the kind of the channel central banks are indeed trying to impact and soften. And certainly, perhaps one of these more ungraspable channels is the expectation channel. It's enormously important in macroeconomic literature, academic literature, because if expectations are drifting, that will certainly impact also how we start making contracts between businesses, what you should expect in a wage negotiation, perhaps not this year, but perhaps in 2 years' time. So, although we might know very little about the future, the current expectation is very important for central banks. So if they can restore their credibility in order to make all agents of the economy believing in that one day, we'll get back to 2% inflation, it will make their job much easier. So that's also one of the key reasons for central banks now to be more forceful and acting with big hikes, although a lot of the issues is stemming from the supply side, supply shocks from the pandemic, from the energy sector. Because the central banks don't want those expectations to propagate through the labor market later on. So, looking across the globe, I just made a quite neat map, I think. I hope you can see it. Just to illustrate that interest rates are rising across the globe. So, if you have an orange color in your country, that means the central bank hiked policy rates at the last meeting. Essentially, there's only a couple of countries that are indeed cutting rates. China is one of them, still struggling with the pandemic effects, and then also Russia and Turkey, kind of two outliers in the more global cycle, I would say. So this illustrates that interest rates are increasing more or less across the globe. And it's all owing to inflation, current inflation, but also expectations about future inflation. So the big question then is how much and for how long? That's always tough to say, right? Only a year back, especially in the US, but also in Europe and in the Nordics, there was a quite consensus that the inflation would be quite transitory. So central banks shouldn't be that aggressive on hiking when it was mostly supply-related inflation. Well, that has changed fast. And interest rate price in the markets have increased almost as fast as they dropped when at the outbreak of the pandemic. I like to look at it a bit more that central banks, policymakers cannot really control things perfectly. No one can. But you have some sort of a interval band or a kind of a credibility band that you're trying to steer both the economy and also the inflation rate around. And if you look at, this is the OECD leading indicator, it says something about the business cycle developments 6 months ahead in time. Central banks and policymakers in general try to steer the economy to hover around zero. Not trying to fire on all cylinders as ahead of the financial crisis, and not seeing a full fallout as we had during the financial crisis or during the pandemic. This is where you all see QE and big rate cuts taking place. Now, over the past 20 years, central banking has been mostly about steering the real economy, because inflation has really not been an issue, at least not to the upside. Rather, the contrary, it's been a bigger question whether you can indeed increase inflation. So central banks have been your friend, especially for housing markets, but also asset prices as a whole. Now, all of a sudden, that has changed. So if you look at the OECD core inflation, it's at the highest level, of course, since the 70s, but it's far beyond and above the tolerance band of central banks, or the credibility level. And this is what makes it quite difficult going forward. A quite gloomy outlook for next year. Also, if you look at the OECD leading growth indicator, it's at, if you disregard the pandemic, it's back to, lowest level since the financial crisis. So it says something about that the growth momentum in the economy is not going to be that good. But that's also what's needed for central banks to see eventually unemployment levels increase, wage growth coming down, in order to restore the credibility in the inflation rate towards 2%. But if you look at this picture as well, what you're essentially seeing is current inflation in red. That's how it's measured. But also looking at transmission mechanisms, the yellow one is more or less what you could deem as future inflation, because it says something about the tightness in the labor market and aggregate demand. So if you kind of take an unweighted average of these two, it says something about what central banks care about: current inflation and future inflation. And the current picture today is this yellow one. We're still way above the tolerance band or the credibility band of central banks. And if you look at how they react then, I'm just taking the average of all G10, so that's all big Western central banks, including the ECB, the Fed, the Bank of England, etc., and looking at the 6-month change in policy rates. So that's kind of the momentum. Are they in a hiking cycle or in a cutting cycle? And as long as you could stay within that tolerance band, they're doing quite good. The key issue now is to bring current and future inflation back into that tolerance band. That's their mandates, that's their one job, and that's why central banking, according to our former governor, is so easy. You just simply hike rates. The tricky part is knowing how much you should hike by and by which time. Of course, if you look at what markets are pricing in, quite similar to our expectations as well, we should have the fastest hiking cycle in several decades. And it should be aligned with current inflation at that time. So based on that, you could say that eventually central bankers are catching up with inflation rates in order to bring real rates also in the short term back towards zero and even in positive territory. Now, what are the implications? So the bad news here is actually, if you look at a long history of CPI inflation, usually US inflation have peaked out in the middle of recessions. Slowing energy prices and also slowing labor markets, wage growth tends to take down inflation eventually. That might also be the case this time around. Markets, turning to asset prices, have already endured some pain, as the Federal Reserve Chair Powell has said. Essentially, if you group the MSCI World Asset Price Stock Equity Index and also the global bonds market cap, you see that the decline since the start of this year, roughly $20 trillion, that's bigger than both the financial crisis and the dot-com crisis combined. Now, you might say this time is different because with inflation, both bonds and equities drop. You don't have that hedge anymore. That's why it's much more difficult to be an investor. But you could also see that all the stimulus from fiscal spending and monetary policy also created a small kind of asset bubble ahead of this rate hike cycle. So are we done yet? Well, it depends on your horizon as an investor, I would say. It's always hard to time markets. And just ahead of yesterday's CPI print from the US, you could argue that it starts to look more decent. If you take for example, the PE ratio, that's a price of earnings on the S&P index, for instance, and look at current pricing as a cyclical adjusted, so that's the CAPE, if you're familiar, saying something about how expensive are markets and at what multiplier are you buying the companies. At roughly 30, a multiple of 30, that's close to one of the most expensive markets seen over the roughly 100 years history we have. And if you then look at your annual real return over the next 10 years, based at least on history, you will essentially being able to now lock in a negative return of roughly 2.5%, based on, of course, historical patterns. That doesn't imply that stock markets can't come up whenever eventually inflation is coming down and central banks are turning to a more softer approach to the economy. But it says something about that markets are still quite expensive in a historical comparison. And now you also have an alternative. You can lock in, you can buy US Treasury real yields with a positive annual return as a perhaps now better alternative than stocks, and safer perhaps. So that's saying something about, I believe markets will become a bit more cheap before people are getting more interested in locking in longer term bets on US equities. Essentially also because usually stock markets often bottom when unemployment rates are peaking. That's when you get the turn of the economy and you get the pivot from central banks. Now, essentially what you're seeing is that labor markets are at the tightest level in a very long time. Housing markets seeing the same thing, strong rise during the pandemic, and now it's starting to calm down, and that could also have secondary effects on consumption, etc. But so these are nominal prices set to 100 just before the pandemic. But I think it's also important to look at kind of the fundamentals in the housing markets. There's big differences across the globe. So if you look at real housing prices and deflate nominal housing prices, but by personal disposable income, some areas are much more in danger of seeing quite sharp price decreases than others. Canada, New Zealand, for instance, 250% real house price increases over the past 20 years, whereas if you look to Europe or even US, much more muted. But the key question going forward is perhaps being in leveraged or deleveraged type of sectors. Because if you look at the past decade, we had a very tight fiscal policy, but loose monetary policy, owing to low inflation. So yields were at record low levels, and it was all about getting leveraged, right? If you look into this decade, you might already see that fiscal policies back in the playing field, being much more loose. You already see the kind of the compensation schemes coming out now across Europe, but also in the US. You know that a lot of infrastructure, both on defense spending, energy spending, perhaps also some deglobalization, could increase both fiscal spending, but also a lot of investment from the private sector, while central banks continue to tackle monetary policy. So you could actually go, that's at least one scenario, you can go from like record low interest rate will never increase to a quite different story going forward, which again will be one of the perhaps more important policy mixes for this decade. And that will certainly be much more important to have good control over your cash flow, and certainly also be more negative if you're highly leveraged. So with that, thank you very much.
Economists are gloomy, but also careful in not shouting fire in places when there's not actual fire. And if you remember, last year we had a Swedbank Economic Forum online, and I had a presentation which you reminded me when you said we have a possibly small bubble in equity markets. I called the presentation a curious case in asset markets, something like that, a curious case, which was a completely nonsense, you remember. Now, this year, we no longer talk about revolutionary cryptocurrencies, non-fungible tokens, paintings, digital paintings sold for $69 million, and so on and so on. So in that part of the asset prices, we have seen a clearly disastrous bubble, which has unfolded and is gone now. In equity markets, it's a mixed picture, but I will have a question for you a bit later, because it's not the same story in Europe and in US. I think in US, for sure, equity prices are still relatively high if you measure by PE ratios, but you can probably see value in some other places around the world. And we'll get back to that. But before that, I think we covered energy crisis, interest rates, inflation. There's one topic that I think gets and deserve little attention, but is equally important now. Indirectly, for us, for Baltic economies, for our home markets, maybe not a pressing and immediate issue, but something that will be relevant in the coming years ahead. And that is China. China has a lot of internal problems that will have global consequences. And for that purpose, I have our economist in Sweden, Glenn, who will tell you a bit more what is happening in China and what we should expect here because of that.
Yes, thank you, Nerijus. It's a pleasure being here at the Swedbank Economic Forum. My name is Glenn Nielsen. I'm a junior economist working in Stockholm, Sweden. I'm here today to talk about China's multiple local problems and how they might affect the world economy. So China is currently facing several headwinds for economic growth, and the first headwind that I wanted to discuss is the pandemic, or perhaps more specifically, how China has chosen to deal with the pandemic. So China has continued with its zero-COVID policy, that's in stark contrast to what many other countries, the strategy that they have opted for this year, namely living with the virus. So this zero-COVID policy, it means very strict lockdowns, contact tracing, mass testing, and quarantines even if only covering a large geographical area, even though just a few number of cases has been discovered in an area. And admittedly, it has been an effective policy in China when it comes to limiting the spread of the virus. But of course, it has come at a very big economic cost. So here, in this graph, you see the number of daily new confirmed coronavirus cases in China. And during the spring, China saw its worst coronavirus wave since the pandemic started. It followed by several outbreaks of this Omicron variant, you know, the more infectious coronavirus variant. And in some days, the number of new cases reached as much as 30,000 new cases per day. And it was also many cases in several key economically important cities for China, like Shenzhen, like the capital Beijing, and perhaps most severely in Shanghai. And that meant that the 25 million people living in Shanghai, they were under a lockdown for 2 months. And that had very, very big economic effects on activity and stuff like this. So we did see, so the Shanghai lockdown, it ended in the beginning of June, and we did actually see, in fact, that the number of new cases, it did stabilize in the beginning of summer, and it was very low. But now recently, it has started to pick up once again. And 2 weeks ago, a new megacity went under lockdown. It's the capital in the Sichuan province, Chengdu. It's a city with, I believe, 21 million people. And now recently, this lockdown of Chengdu has been extended indefinitely. So that will also have big implications for the economic activity going forward. And last week, across China, there were 65 million people affected by lockdowns. 65 million people, that's more than double the number of people that lives in all Nordic and Baltic combined. So we believe that China's zero-COVID policy will be in place for a long time, well into the remaining of this year and also a bit into next year as well. And one argument for this, or a reason for this, is that China is, of course, the most populous country in the world, but also there hasn't been that many infected by the virus, so the population has a low amount of herd immunity compared to several other countries. So if China would be to open up, it could have very big consequences. Many people could get infected by the virus, and that could put huge strains on the Chinese healthcare system, and that could potentially risk that many people would die from the virus. So it's also a big political considerations because of this. But maintaining this COVID zero policy, that will come at a huge economic cost. It affects consumption, it affects business production, and of course it also limits the efficacy of various stimulus like fiscal policy, monetary policy, and stuff like this. So we saw in economic data that the economic activity was very weak during the second quarter due to these strict lockdowns and due to the pandemic. So looking here in the graph to the left, we see the GDP growth, and GDP declined by 2.6% in the second quarter compared to the first quarter. And this was the weakest economic development since the start of the pandemic. And of course, a major factor for this was the lockdown of Shanghai. And this figure of minus 2.6%, of course, it was expected to be weak growth during the quarter, but it was even weaker than what many had expected beforehand. And here in the graph to the right, we can also see a bit more detailed how the pandemic hit the economic activity in China. So, for example, we see retail trade on an annual basis. It declined by quite a bit, and it just highlights how the COVID zero policy affects consumption in China. So, for one, it means that people simply cannot go out and consume, as was the case with the Shanghai lockdown. But also, the zero-COVID policy means that people might not want to go out and consume, simply because of the fear if they went to a location where someone had been infected by the virus, tested positive, that would mean that they would have to get tested, potentially being in quarantines and being into lockdown. So, of course, it also affects the kind of willingness to go out and consume. And we also see weak industrial production, of course, as a result of manufacturers having to shut down as well, or limit or scale down on production. So we did see an uptick in the beginning of the summer after the Shanghai lockdown ended, but since we have this renewed virus outbreak since then, it risks putting a dent on the economic recovery. And the economic recovery is expected to be quite slow, and we can see this by looking at several forward-looking indicators. So, for example, here in the graph to the left, we see consumer confidence. So this is an index that goes between 0, so 0 is extreme pessimism, 200 is extreme optimism, and 100 is some form of neutrality. And this is, for the first time ever, that this data is significantly below the 100 line. And consumer confidence, that's also on record lows in many other countries, Sweden, Europe, the US. But in those countries, it's because of the high inflation and because of rising interest rates. That's opposite of the reason why it's so depressed in China, because China has a low inflation rate, it's below 3%, and as we mentioned before, China is even cutting interest rates. So obviously an effect of the record low consumer confidence is because of the pandemic. And also business sentiment we see here is very weak, so purchasing manager index, a value above 50 means that the sector is growing, a value below means that it's contracting compared to the previous month. And we see that the manufacturing sector has been contracting for 2 months in a row. Non-manufacturing sector, it's above 50, but you can see that it's going down recently. And I think it has the potential to fall even further, given the obvious effect that the pandemic and COVID-0 policy have on the service sector. Yeah, the pandemic have very large domestic effects on China. But we also saw that during the pandemic, it caused many big global consequences. And one thing that Matthias mentioned was the global supply chain issues, so the problems that became very apparent during the pandemic, where we saw very long delivery times, we saw very high shipping costs, and we saw a global shortage of inputs, of various inputs like semiconductors and stuff like this. And part of the reason why we saw these global supply chain issues, that was because the economic recovery happened very quickly after the initial downturn during the pandemic. And that meant that as the economic recovery took place, the demand for various goods increased quite a lot. And that meant that the demand increased at a pace where supply couldn't keep up with it. But of course, another factor was due to the various lockdowns in parts of Asia, and especially in China, where we saw big ports being locked down, and not only ports, but also major other cities. So we see now that global or shipping costs from China to the US and to Europe has come down quite a lot recently. And we see also in other data that supply chain problems are easing, but as you can see, it's also far from how it was before the pandemic. And also keep in mind that out of the 7 out of the 10 busiest ports in the world are located in China, and Shanghai is the busiest port in the world. So this COVID-0 policy and the risk of renewed virus outbreaks, it always risks putting renewed global supply chain problems. It always risks that. And also one thing that Matthias mentioned, so these are all kind of temporary effects, I would say, and these global supply chain issues will get better over time, obviously. But perhaps a permanent effect from the pandemic that Matthias mentioned is that we might see kind of more reshoring, firms moving production more closer to home, because these global supply chain issues that became so pressing during the pandemic, it really highlight the fragility of supply chains and being dependent on countries far, far away from home, and also the intricacies of the supply chain issues and the complex infrastructure of it. So it might be that the pandemic left a permanent scar and that had global consequences on the world economy in terms of de-globalization. So let's leave the pandemic behind and move into China's other major headwind to growth, and that is the downturn in the Chinese property sector. So China's property sector has for several years been a key sector for economic growth in China. But in recent years, this growth in the property sector has been fueled by a very high amount of borrowing by property developers. And to limit this kind of high borrowing for property developers, authorities implemented a policy that became known as the 3 red lines policies that was aimed at limiting the amount of debt that these property developers were allowed to take on. The problem was that this policy took place very quickly, and at the time of implementing it, several property developers had already passed 1, 2, or even 3, all 3 of these red lines, which essentially meant that they were not allowed to take on any more borrowing, and they had been used to be able to do that, to be able to finish their projects and to keep keep the sector running, essentially. And this has had a very broad effect on the property sector, and it has led to many. So this debt crisis has led to many property developers being unable to finish their production, and it has also caused deteriorating in the home buyer sentiment, because people are afraid of buying homes if they don't know whether the housing that they buy will be delivered. And also this latter part is also exacerbated by the COVID-19 policy, because it's very hard to go out and buy homes if you're not allowed to go out, essentially. And here we can see some examples of how this property sector downturn has affected. So to the left we can see that the number of building starts, the number of completions, and the number of housing sold, so this is the residential property sector. From the start of this year until now, that's much lower than during the same period last year. And also here to the right you can see that the price of both new homes and existing homes, that has been falling for 11 months in a row. And this property sector downturn, it's quite a big deal for China. So according to some estimates, Chinese real estate sector, it accounts for as much as 30% of China's GDP. So this downturn in China's property sector will have huge consequences on China's growth. So 30% of China's GDP, that's much higher than what the real estate sector is in many other countries. That brings me to commodity prices. Also, Matthias mentioned that. So during the pandemic, we saw that the prices of global commodities increased quite a lot. And that was due to the supply chain issues that I mentioned previously. And also, following Russia's invasion of Ukraine, we also saw renewed, very broad price increases on many commodities, especially energy, oil, but also metal and food and stuff like this. But recently, actually, many global commodities, the price of them has been decreasing. We saw, for example, last week that the price of a barrel of Brent oil that dropped below $90 per barrel. I think now it's above that again. But still. And so one reason why global commodity prices are decreasing is because of a global fear of recession. But also another major fact for this is because of the slowdown in China. So China is the world's largest consumer of commodities. So the development of Chinese economy will have huge effects on global commodities. So a channel that it works through, since it's the world's biggest consumer of commodities, we see that imports now from China has been slowing down quite a lot, and so that's basic economics. If the demand of something goes down, then the price of it also goes down. Also, the property sector is also related to this decline in global commodity prices, since the construction needs many commodities, metals, steel, iron, but also cement and wood and stuff like that. So that also has a big effect on global commodity prices. But China doesn't only import commodities to use domestically, it is also used in the production of much of the manufacturing exports. And it's quite likely that we will see a decreasing demand for Chinese manufacturing exports going forward in developed countries. And that's because of the high inflation there, which means that consumers are cutting back on spending. But also, we're seeing a kind of a shift from consuming pandemic-related goods to consuming more services. And that will also have an effect on the demand for Chinese manufacturing exports. And that also means that the prices of global commodities goes down. And also, as Matthias mentioned, so global commodity prices decreasing, that means that global inflationary pressures are also declining. So another major economic headwind that China experienced this summer was extreme weather. So in the northeast of China, it was very large flooding, and in the central and southwest parts, so more than half of the country experienced heat waves, record heat waves and droughts. And this was the worst heat wave in China ever since records began in the 1960s. And that will have also broad effects on Chinese economic activity. So I can give you an example. The province of Sichuan that experienced temperatures of above 40 degrees Celsius. So it broke many temperature records. So one effect that extreme weather has is that on energy production. So Sichuan, for example, that's a province that have access to rich water sources, and it uses a lot of hydropower in its energy production. 80% of the province energy production comes from hydropower, and it also supplies nearby regions with a lot of energy. But due to these heat waves and droughts, the access to water was limited, which meant that the production of hydropower was severely hampered. And that also comes at a time when the demand for energy is quite high, of course, since households and business want to keep cool using air conditioning. So it has kind of a big effect. And this actually meant that the provinces had to ration electricity between households and between factories and between offices and public transport. And it meant that some factories had to shut down production or run at reduced capacity, so that puts further strains on global supply chains once more. And Sichuan is a very large manufacturing hub. There are many of the global car factories there, manufacturers there. And another fact that extreme weather events have is that on agriculture and food production. So big heat waves, it damages crops. It also affects livestock. For example, chickens, due to the high heat, didn't want to eat as much food anymore, which meant that they laid much less eggs than normally. And of course, this comes at a time when already global supply of food is severely hurt by the war in Ukraine. So the fact that China might also face potential shortfalls in its autumn harvest of wheat and of rice, that might be another stressor on global food supply. And China is also the world's largest importer of food, so this could have also big effects on the global price of food again then. So earlier this year, China set an official GDP growth target, and this GDP growth target was to have a GDP growth of around 5.5%. But given these headwinds that we see, it is quite unlikely that China will be able to reach this growth target. So our forecast is that China's GDP growth will be 4% this year, so quite a bit lower than the official target of 5.5%. And I see that risks are unevenly balanced. I feel like it could be also much worse than 4%. But it's quite interesting. So this graph here shows the red bars, that's China's official growth target. And the yellow line is China's official reported GDP growth. And as you can obviously, China is very good at reaching its growth target, since this yellow line is above the target every year, almost every year. But it looks like 2022 might be the one exception to this, if our forecast of a 4% growth becomes reality. I should also mention that recent signals has been that it's gonna be it's acceptable to miss the growth target due to the circumstances. But nevertheless, I think this is interesting. So to conclude, China is the second largest economy in the world. China's GDP accounts for 1/5 of global GDP. So the slowdown in China's economy, that has huge effects on the world economy as well. So China's domestic problems that have big global consequences as well on the world economy. Yep.
Thank you, Glenn. Oh. we have some questions from audience online. You can also raise your hand. We have a microphone. You can ask a question in any preferred language, in the Baltic, Swedish, German. We have economists who can take any of those languages. And I feel obliged to say something good about the something optimistic. And actually, some of the questions that we have already received from the audience leave us to that. One question is about the divergence in growth in the euro area. Why, for example, Spain is doing quite so well this year. So it's not universally bad. We use this opportunity to highlight all of the problems that are ahead of us, but it's not as bad as it was in 2008, for sure, on many aspects. And we have really bright spots around the world and also in Europe. And for example, Spain is one of those countries that is almost an energy island. It never imported Russian electricity or Russian gas. It has LNG terminals. It has all the needed infrastructure. It is in no rush to build up the reserves. And of course, due to the geographical location, it's a bit less sensitive on the need to heat up the buildings. It has been booming at least until now due to the recovery in travel and tourism sectors. So Portugal, Spain is less dependent. But we also have a darker spot across euro area. Germany is one of those countries. And Glenn highlighted problems in China. This is not so relevant for Baltic countries directly. Less than 1% of Baltic exports go to China. So we can afford to see a slowdown in China. But if you look at the secondary effects, for Germany, it's the biggest export market. For Baltic countries, Germany is one of the biggest export markets. And already now, Germany is suffering dramatically. If you look at the manufacturing output in Germany, it's not down a few percent compared to last year. It's now at the levels that we have seen in 2014. German manufacturing is down to the levels that it had in 2014. Big part of it is problems in car manufacturing industry and related industries. But some of the problems are already related to energy shocks, energy rationing, electricity price, natural gas price. You remember the slide that Matthias has showed. The price of electricity has been even higher than in Baltic countries. Here locally, we were shocked and we thought that it's our own local problem, homemade problem. It's not. It's Europe-wide problem with a few exceptions. So Germany is, I'm very pessimistic. Perhaps Matthias or others will disagree on that, but I'm very pessimistic about German prospects, and that's one of the factors that will weigh down on growth here in Baltic countries. Now, the second question we had, and I will pass that question perhaps to Matthias or Kjetil, is it's a good question on the ECB. Can ECB afford hiking interest rates as it did until now, as it plans to do it going forward, given the fact that Southern European countries are so indebted? I mean, we are, in terms of debt to GDP levels, we are not in a better situation than we were during the euro area debt crisis 2010 to 2015. And we already see now that Italian borrowing costs are well above 4%. Can we afford to have such a steep increase in interest rates? What's your take on this, Matthias?
Yes, I think I was a central banker during the global financial crisis at the Riksbank. And I think what Europe did back then was to kick the can down the road, take a bet that growth in Europe was going to be much higher coming out of the global financial crisis. Then came the euro crisis, and they did it once again. They kicked the can once more and hoped that growth will pick up and will be above average. I think the problems in Europe when it comes to spreads is fundamental and structural. Unfortunately, nothing will happen. So if you listen to the ECB, they say we need conditionality. Here in Latvia, you know all about conditionality, because that's what IMF do. They use conditionality, and that was exactly what IMF did in the Latvian program in 2008. Which means that you need to cut back on fiscal policy in order to get access to the ECB regime. Unfortunately, that doesn't work, because there is no institution in EU who can force southern economies to strengthen fiscal policy. To me, it's all a game. Not a game, that's not a kind word, but that everybody's in a position to game the ECB. The ECB is the only institution, if you don't have the conditionality, to do something, and that is to kick the can once more. And how do they do that? They use the balance sheet. And they talked a lot about the anti-fragmentation tool. I really like that word. It's so, I think it's a cool word. But then they changed it to something less interesting word. And we already see that. So ECB is buying much more sovereign bonds from Italy, selling or not investing as much in German bonds to control the spread. So to me, yes, they will continue to hike, and they will continue to explode or expand the balance sheet, because there is no other options. And inflation is political, I think. Then I think markets are too aggressive when it comes to monetary policy. But they need to continue hike. I don't know if you agree, Kjetil.
I fully agree.
That's good.
Yeah. So in other words, ECB is very good at using these difficult words to disguise what it is actually doing, you know, anti-fragmentation policy, transmission protection instrument. It sounds good, it sounds technical, but what is actually it is doing, it is what I think, it needs to increase interest rates to fix its reputation, to control inflation expectations, as Kjetil said, to control the exchange rate of euro, because if euro continues falling against US dollar and other currencies, then we'll see continued increase in inflation, imported inflation. So it needs to increase interest rates, but at the same time, it needs to print money or implement anti-fragmentation policies. Well, print money is also not completely accurate word, but basically it is buying bonds, buying assets in order to provide sufficient liquidity to commercial banks, to governments, so that the governments can provide the help.
And I'm not saying the ECB is not doing what they should. ECB is forced to do it because we don't have the institutional setup we need in Europe. So it's not really the fault of the ECB. They need to keep the euro together. So they will do whatever, not almost Draghi term.
Yeah, it's a good place to remind that, can we have a microphone over there? And Draghi, in 2015, I think, said we will do whatever it takes to save the euro. When Italian borrowing costs went up to 7%, it was obvious that Italy was going for insolvency. ECB or European Financial Stability Fund, European Stability Mechanism didn't have 2 trillion euros to help Italy. So ECB said, we're going to do whatever it takes. And it was enough. So now they will not do whatever it takes, but they will probably do a lot. So we have a...
Yeah, this is the continuation of my question. But this cannot go on forever. I mean, this is inevitably going into some kind of crisis. The northern countries are, not spending that much. They are cutting and they are doing what it takes, and the southern are not. So, what's your forecast? Is it the breakup of euro, or how it's going to end?
Yeah, I think you put the questions right where I think about it. So, never waste a good crisis. So I used to work very close with the governor of the Swedish Central Bank, and that was something he always said, never waste a good crisis. And the Swedish government tried to do that during the global financial crisis. Here, you absolutely did it. Under the IMF program, you were forced to do it. So for Europe, unfortunately, I think we need a crisis. There needs a crisis in Europe where the institutional setup may be close to fiscal cooperation, IMF has been out now with a paper last week arguing for, and there are many who have thought that. We talked about the European IMF already during the Euro crisis. Nothing has happened. We kicked the can, and things got better, then pandemic, and now it's bad again. So I think, unfortunately, you know, never waste a good crisis. I think there will be a crisis, and I'm not sure when, or maybe it's not now. But as you say, balance sheets will continue to expand. Political problems in Italy, a new government, debt level is too high. But it's not only Italy. Look at France. It's much wider. So unfortunately, I think you're right.
No, the good thing now is that in 2010 to 2015 Euro area debt crisis, we really had a well-performing Central and Nordic European countries and really struggling Italian, Spanish, Portuguese economies. Now, Germany is also struggling. So it's a bit of a more universal need to help and create institutions and create instruments to help Euro area countries. But we agree on that ECB has now much weaker powers. Now that the inflation is here, it needs to increase interest rates. So European Commission, international institutions, either existing or the ones that will need to be created, will have to take over that job. We will need to see some sort of federalization of Europe. Bigger budget, bigger common instruments to stabilize and synchronize business cycles. It is difficult to do that. I think that one of the creators of European Union, Monet, said that it's difficult to implement these reforms when everything is fine. They're politically difficult to pass. German voters want different things than Spanish or Italian voters. But once there is a crisis, when push comes to shove, then these things are implemented. And we've seen that during the recent Euro area debt crisis. So I'm not too worried about a breakup of the Euro area. I think the political consensus and the general public understanding that we need common Europe, stronger Europe exists, especially after the war in Ukraine. And we have another question, and I told you, Kjetil, we get this question every year. We get it again, and you are the one to answer this. Where do we see Euribor and Euro exchange rate in the future? Our official forecast, market expectations, and your personal view. Because what markets expect now, after recent rapid increase in prices and rapid hikes by the ECB, now last time I checked, yesterday, I think Euribor futures were close to 3% in the middle of next year. That is a lot compared to zero with which we lived during the past 10 years. We forecast that, our official Swedbank forecast, that ECB will continue increasing interest rates in October and December, and then will stop because of the recession. What ECB is saying, and markets are saying, that ECB will not stop. Recession or not, unemployment or not, bankruptcies or not, they will continue increasing interest rates until inflation is on a steep path downwards. So we think that ECB should not be making this mistake, but at the same time we agree that whatever it does, it is choosing between a terrible and very bad decisions, either letting the inflation run without doing anything or creating a recession. Which is better? What would you do?
If you look at it from kind of the broader scope, I think one of the key benefits here for Europe is really that the wage growth is not peaking, like in the US, where they're forced to actually make a bigger pain on the labor market. So if politicians manage to get the energy situation under control, I think the inflation rates in Europe could roll over much quicker than was priced in. If they don't manage to control it, that's a bigger problem. I mean, you're talking about ECB is not doing whatever it takes, but the ECB is really stretched.
Yes.
And they're trying to implement two types of almost whatever it takes at the same time. Both hiking to control inflation, but also to control fragmentation in Europe. And I think they feel forced to do it. And that's also why they start hiking by 75 basis points at the time where you see the recession is almost unfolding in front of your eyes. So this time is very different in the terms that central banks are forced. And certainly also that energy situation, because I think markets are pricing in both trade balance, current account type of deficits in Europe. You see it already in Germany. It's a very different situation than for the past 20 years. That also has a big impact on the euro exchange rate. So the key here for Europe is certainly to fix the energy situation pretty fast, or at least reduce kind of the downside risks or the tail risks to the energy situation. I think you've solved a lot of short-term issues already there, both for the ECB but also for the exchange rate.
So are you saying that the euro will stay below parity, will be cheaper than dollar until the energy crisis is solved?
I mean, you could say that there's a lot of things priced into the dollar already. It has a tremendous rally this year, both based on that the Fed has been out hiking all the central banks, but also kind of this global fear of recession. Certainly you want to seek to a safer harbor. Also, the energy situation in the US is much better than compared to Europe, for instance. Adding to the downside risks in the US has been smaller, at least over the past months. So yeah, I think my view here is this will continue for some time. The big question is whether you manage to get a soft landing in the US and whether the Fed will keep policy rates high.
And I think that that's a good segue to the final question that we can take in this session. It's a brilliant question. When will this crisis be over? Well, can we expect already recovery in 2023? And you already, Matthias, talked a little bit about this being a lost year in 2023. But perhaps to elaborate a little bit on that, what do we need to see to be able to say that, okay, we are turning the corner? Because obviously now we are not saying very new things. We are just stating the facts that ahead of us we have a problem related to inflation. Purchasing power is falling across Europe for the first time since many years. We have energy crisis. We have increasing interest rates. We have China, which is struggling and through direct and indirect effects is affecting us. So a lot of problems are stacked together. Okay, we spent an hour explaining how terrible the world is around us. What do we need to see to say that this is the turnaround? Can it happen in the middle of 2023? Or are we going to have a few dark winters?
I think the real problem here is that labor markets are so tight. The business cycle has been firing on all cylinders for far too long time. So usually when kind of that turning point in a positive direction happens is when unemployment rates start dropping again.
But they cannot drop there so low.
Exactly, they need to increase first. And that's kind of what central banks essentially are saying that will happen.
No, but if I'm a bit more pessimistic. So you're looking for some bright, but I think for me, so we have a forecast. We always have forecast for 2024 for global economy to rebound. I think that is still possible, but for us that is based on a few assumptions. One, inflation will come down. Two, I think the energy crisis in Europe needs to be resolved. We need to support households and corporates, and for me, fiscal policy individually doesn't really work, because Italy doesn't really have a room. France doesn't really, okay, Germany, sure. But there are many countries. We in the north, we can manage. Southern parts or continental Europe, not so much. So I think EU Commission is key. So why am I more pessimistic? Because I see inflation in the US surprise on the upside, which means Fed needs to do much more. Inflation in Europe are also surprising on the upside. ECB needs to do more, which means more hikes. The same for Riksbank. So all central banks need to hike more. That's not good for us. That's not good for business. It's not good for households. So I question if whether or not we are too positive in our outlook for 2024. That's not to say that I think we're going into a deep, deep recession. But maybe we will see a bit lower growth than we actually have in our forecast. But that's on the risk side, I think. What we need to see is EU Commission doing something about energy prices without distorting the market. I think that's the most important thing.
Thank you,
sorry for that, Nerijus.
Oh, I'll have to fix that myself. Thank you, Matthias. Thank you, Kjetil. We're going to have a break now, but I think after the break I'll tell you why there are reasons not to be so pessimistic.
I have some questions for you.
Good, we can continue. But for sure, I've seen something interesting, and you've seen something interesting on Glenn's presentation. I mean, the fact that the transportation costs have fallen by half, that in itself will create smaller inflation. Falling commodity prices, that will create smaller inflation. The question is, of course, an uncertainty, is it enough to have inflation dropping from 9% to 4% to make the ECB stop? Fed will not stop. Fed will create the recession. That's fine. But in Europe, we may avoid a dramatic increase in interest rates. More importantly, I think it's very interesting to look how do Baltic countries look in this environment. And we've seen that during the pandemic, we have actually outperformed many countries across the European Union, despite the gloomy expectations from European Commission and not from Swedbank. We were the ones that we were saying that this is going to be fine. But after the break, we have 3 excellent presentations on the state and the forecast on the Baltic economies, on the energy crisis, is it really bad in Baltic countries, what to expect in winter, and on something that already Glenn has talked about, and something that gets too little attention in the media, the price of extreme weather. The 2022 has been the year of records, record inflation, record increase in interest rates, record heat waves, record energy prices, record floods, and so on. So this particular topic, the price of the extreme weather, which will reach us, already is reaching us, we'll discuss that during the next hour. So stay tuned, have a coffee here or wherever you are, and we'll see you in 20 minutes. Welcome back. I see and hear lively discussions. I've heard twice during the breakout session the words, I'm not a pessimist, but... So I'm also not a pessimist. Very often I hear... during the past years, I used to hear that I'm excessively optimistic. That has never been the case. I was usually very realistic. And I think now we are very realistically assessing the risks and possible scenarios for the Europe and the world going forward. And just during the break, we saw that Ursula von der Leyen, the European Commission, is already preparing something. I did not have time to read what's the plan in order to cap the prices and ease the pain on businesses and households. But we're probably sure that politicians, with all the, regardless how we dislike them in most cases, will come up with something, and technocrats will come up with something to help us to avoid the worst. But having said that, the situation on energy front is not great in Europe, and is peculiar in Baltic countries. To highlight on what's the situation there, I asked my colleague Agnese, who is acting chief economist at Swedbank Latvia, whom you know very well, please, and tell us what to expect this winter. Is it going to be bad or quite okay?
Well, you know, I don't have that crystal ball, but hopefully we'll manage. But let's not jump ahead of ourselves. Today I will be concentrating more on the Baltics and Finland, and less on the Europe as a whole, because that would require another presentation, and probably not in 20 minutes. So what we see that given geopolitical events, the war, the geopolitical crisis, political crisis, Russia is curbing natural gas supplies to Europe. And we see a lot of headlines with countries who have been switched off or with countries who have received less gas than previously. For example, Finland, Latvia, Gazprom has announced that they're not supplying gas anymore. And there has been a race it's already in full swing in Europe to fill up all the storage and prepare for the winter as much as possible. And replace Russian gas as much as possible. And the most recent one is switching off Nord Stream 1, which is one of the biggest gas pipelines going from Russia to Europe, in this case, Germany. And what EU can do, obviously, we have to reduce our consumption. And the European Commission, or let's say member states, have agreed voluntarily to reduce the consumption by 15% this going forward for this winter. And so far, we're doing more or less okay with that. We see that it is starting to affect production. For example, a big fertilizer maker in Lithuania has suspended operations because natural gas is an important non-energy input for this business. But also other businesses are feeling the hit, not maybe yet because of shortage of the resource, but because of costs, because of high prices and investments needed to switch away. Yes, so the situation is not very bright and nice with respect to the energy in Europe, and it's happening after a lot of years, Europe enjoying the cheap Russian gas that has come to end. Estonia and Latvia, maybe less so Lithuania, have been really dependent on Russian gas. And here you can see 3 graphs with export and import flows in these countries. So if we look at Estonia, we see gas is coming from Latvia, from Russia. But Latvia is not producing gas, obviously, so that's Russian gas. So it's 100% Russian gas previously. Now things are changing. If you look to Latvia, what do we have here? We have Russia, and Russia is blue in all these parts. We have imports from Russia and imports from Lithuania. And where we are exporting, obviously, to Estonia, and since we have underground storage facility, then something goes back to Lithuania as well during winters. And then we come to Lithuania. First of all, we see a lot of blue, which is imports from Belarus, exports to Russia. And this is largely transit flows coming from Belarus, that's Russian gas, and going to Kaliningrad. And it has, so previously something stayed also in Lithuania, but not anymore, not since April this year. So it's just transit. So you can take out the blue part here. And we see that other sources are coming into play much more. And that's thanks to the Klaipėda LNG terminal. Without that, it wouldn't be possible. So you see imports from Norway, the purple columns, imports from Norway, from the US, recently from Egypt. And those are going further to Estonia, to Latvia, then to Estonia, and also to Finland. Actually, it's peculiar how Eurostat makes their statistics, because if I look at Estonia, they don't export natural gas. But if I look at Finland, they import natural gas from Estonia, and now increasingly so, because they have also been cut off from Russian supplies in late May. Yes, and obviously Klaipėda now is the main source of main infrastructure point and source of imports of natural gas to the region. And so in general, how important is natural gas in our economies? What is its share in the consumption? So it's around a quarter in Latvia and Lithuania, so it's quite important. Less so in Estonia, just 8%. And for comparison, you have here also Poland and Finland, which is neighboring countries. And at the same time, we can also look at the share of renewables and biofuels, the blue part. It's also quite significant. And over the past years, it has been only increasing. And this tectonic political, geopolitical shift will only accelerate the shift towards renewables, towards biofuels. But we might take a few side steps before that happens fully. And the share of gas has been coming down, but not very quickly previously, and that is also changing now. Baltic states, so it's important to understand how much do we consume in order to assess whether that's going to be sufficient or not, and what are infrastructure possibilities. So around 40 terawatt hours of gas. Obviously, Estonia uses the least, because we saw also the country is smaller, and we also saw that the share in the energy mix is smaller, and Lithuania is using the most. But then we have to take into account also Finland, and then it's 60 plus terawatt hours, which is quite a lot for a region with the current infrastructure relying now on, and current inflows relying now on Klaipėda, which is around 40 terawatt hours of gas, the regasification capacity. And in the first half, it was only about 13 terawatt hours that came through Klaipėda. But in the first months, it wasn't perhaps fully utilized as it is now. So and here we have to understand that Klaipėda is servicing or accommodating not only Lithuania, not only Latvia and Estonia, but also Finland, because we don't have Russian inflows, or almost no Russian inflows anymore. And then we have also Poland, with the recently opened connection in spring this year between Lithuania and Poland. And we can see that currently, in the 2 months, in May and June, for which we have data, more gas went to Poland than the other way around. So Klaipėda is also used by Poland. And what else? So in theory, this is another potential source of gas coming in, but that hasn't happened yet. Then we have Klaipėda, and we have Inčukalns storage unit in Latvia, but we have to fill it up in order to use it. We'll see how we are doing with that later. And there are some currently already insignificant Russian inflows, but obviously they are unreliable. And as I mentioned, Klaipėda is not enough. And we have also regional infrastructure bottlenecks, because you can have as much terawatt hours as you want here, but you have to transport them through this bottleneck between Lithuania and Latvia. And this is currently the weakest link, I would say. The good thing is that they're planning to increase in the coming months the capacity of this transmission interconnection channel by 1/3, which is quite important. And then there are also additional LNG capacities planned in the region. It's going to be either in Paldiski or Inko. We'll have the floating terminal. It's already coming from Argentina, which is also a very good sign. And it seems that infrastructure works both in Paldiski and Inko are proceeding according to the plan. So it's encouraging, but it's not yet there. So obviously, we have to take into account that there can be risks associated with that. I already mentioned the increased capacity for Lithuania-Latvia pipeline. There's one more thing called Baltic Pipe. That's a connection between Norway and Poland, which is opening up, and hopefully will reduce Polish demand for Klaipėda. And then So this is internal infrastructure, but we have to take into account also what happens globally, whether globally we have sufficient amount of LNG to be delivered to Klaipėda, to be delivered to Inko or Paldiski. And if we look at this other infrastructure object that is so important, the underground storage facility, we see that lately it's not, we are not doing that much in filling it up. In Europe as a whole, we saw earlier that they are more or less on track, but we are not. And one of the reasons is that Latvijas Gāze, which is a large gas trader and provider in Latvia, they haven't made reserves for the winter. And there are obviously some political reasons most likely involved, given that Gazprom is one of the shareholders, but they are claiming also that there are market reasons why they haven't been able to do that. But we can judge ourselves what's the likeliest reason. So we're not doing that well now, so that's kind of a bit of a reason for concern. And this is a caricature which is showing that Latvia's Gāze is saying one thing and the government is saying something else. So they're looking at the same underground storage facility and they see different amounts of gas stored in it. And that's obviously a political dispute. And here also the overall capacity is 24 terawatt hours, so at the moment we have 12. And I should mention here that it can be used by Finnish, Estonian, Latvian, Lithuanian gas companies, and even Polish if they wanted. And I also, what else I wanted to mention here is that we don't know who owns what. It's not publicly available, it's just what we hear in media. Most of it is owned by Latvian providers, but then again, it's not a closed market. We are operating across the markets, and we have companies here that are supplied by Estonian companies and other way around. So it doesn't matter actually who owns what, it matters how much we have here in the region. Because then it's only about the price. Then it's important to understand who consumes natural gas here. And we see that in Lithuania, about half, or around 11 terawatt hours, is consumed by this large fertilizer producer that I already mentioned. I think it's pronounced Achema. So they halted their operations in September and are planning to be on kind of this halt at least until December, but they also reduced their capacity. Not now. They reduced their capacity to third already last autumn. So they have been hit by the price increase already for some time, and also fading competitiveness compared to the US market, compared to Canadian market, where fertilizer production is cheaper. And that's true for the chemical sector in general. So in the other Baltics, a quite significant part is energy transformation, which is electricity and heat producers. In Estonia, in Finland, it's also the biggest bulk is this orange part, about 60%. Households is relatively small part, about 1/10 the purple part, and it's quite clear now that there will be sufficient amount of gas for households. For companies, we'll see. But for households, there going to be enough gas. And obviously, industry is another big chunk of gas consumption. So here you can see electricity production. We see that Latvia and Lithuania depend quite a lot on natural gas and electricity production because of thermal power plants. It's not used in Estonia, so they have shale oil that is used in great amount there. And also a significant part is at least in case of Lithuania, is not covered by local generation of electricity, but by imports. And in Estonia and Latvia, we also import some of electricity, especially now when the generation of electricity in the recent months has been quite low, and that's one of the reasons why the prices have come up. One is expensive gas, but also reduced renewable generation. And we see that we imported also electricity from Russia, and we stopped doing that for security reasons, mostly. So we see that Russia is here, the light purple line, so that's for whole Baltics, and we import more from other EU countries, from other EU countries. Mostly it's Sweden, Finland and Poland. And we're not buying electricity for commercial purposes. We're not buying electricity for balancing needs. But we're still using we're still part of a Russian electricity system, which is another risk. It's called Brel ring. Russia regulates the frequency in our electricity market, and that's a potential risk. There is the coupling from Russian system is in process. I mean, infrastructure is being built. Here we can see that these links, they still have to be built. These have already been done. Also here, so quite a lot of work still needs to be done. Some investments in IT systems, in other infrastructure, in physical infrastructure, and so on. So we can't do it now. It takes time, and we could join European power system in 2025. If the worst happens and Russia decides to turn off the switch, we will manage, but it's the issue of the cost. It's, as I was explained, it's like moving into an apartment that is not fully furnished. We have some light bulb, we maybe have a sink, but that's it. So it's not very, it's livable, but it's not very comfortable. And in this case, it's very expensive, but it's possible. Then also we use gas in heating, obviously. That's true for all the countries. But now increasingly we see a switch to alternatives, dirtier and cleaner alternatives. We see both directions. When we assess how the consumption has been doing this year, we see a very nice 39% drop in the region. It's including Finland. So if we can sustain this, then it's really nice. And bulk of it is insured by Finland. And most of it happens because we generate less electricity, we generate less heat using thermal power plants, and also because the winter was quite warm compared to other winters. And obviously the price signals are also working, so there is some replacement, some investment that is front-loaded in order to switch away from gas. And here I ask this question whether this decline can be sustained. And you can see natural gas consumption in Baltic-Finland region over the heating season. And we see that this 21-22 heating season stands out with a lower consumption. And that's beginning of this year as well. And if we look at temperatures, unfortunately, I was able to find them for Latvia only, but I assume they wouldn't be that different, at least trend-wise, for the whole region. So here you can see different heating seasons. And this purple thick line is the last heating season. And you can see that in January and February, although December was cold, but in January and February, this line is higher up than other lines, which means that the temperatures were lower, so we didn't need so much heating, and we could save on gas. for obvious and just logical reasons. There are a lot of unknowns to answer this question for sure, but a HEMA halting production is definitely helping, although we have to take into account that they weren't at full capacity during this heating season, for example. Switching to other alternatives is also positive. We see indications that Finland's one new additional nuclear unit could come up into market. It's already in the market. They're testing the capacities and so on, but that should alleviate the price pressures of electricity. We see that probably high prices will lead to reduced consumption of heat, like consumers, households turning off their heat meters by a degree or two, and also companies saving on energy costs as much as possible. But we don't know what this winter is going to be like. There will be more operation of thermal power plants in the second part of the year. We see that already. For example, in Latvia, they were switched on after we saw the record 4,000 euros per megawatt hour in one particular peak hour in the middle of August. So that's adding. And there may be other factors that we are not foreseeing now. So a lot of unknowns. But in general, if we have this Paldiski terminal in place, we should be fine. So assuming consumption of 47 terawatt hours, which is average over 5 years, and I take into account here half of September as well, then we have 12 terawatt hours in inch accounts, so that's already there. Then looking at what's booked in Klaipėda and betting on what could the Polish demand be, I have no idea. I know that 1 terawatt hour went there in 2 months. Then about 18 terawatt hours could come from Klaipėda. Then reduced gas consumption, I'm conservative. I'm taking 25%, not 40%. Then we could save 12 terawatt hours. And then Paldiski, which has higher regasification capacity than Klaipėda's terminal currently, should add quite a lot to the balance, which means that we should be fine unless we have this part and we are able to save. If we don't have this part, then we have to save more. Then we have to save 40, 50%, something like that. And this is assuming full capacities everywhere and everything perfectly working. So it can, it's life. Things happen. But in general, it looks that it could be fine. So most likely, we can avoid very rigid gas rationing in the region, but it's going to come at a steep cost, and we already see the cost. Those are spiking prices, both gas, also electricity. And we see some future developments from the financial markets suggesting, at least for the gas, easing over coming years. But then this part adjusts whenever the last point of actual data is. For example, when we were here, this dotted line started here. So it's moving according to the, But basically, after this winter is over, there should be some time of relief, but I would be very cautious about the next winter, because it's a question also in wider Europe whether we will be able to replenish the storage, because by the end of this winter, it's going to be almost like to zero. And that's not how it usually has happened before. And we have to also take into account that also filling the storage levels at this level, we used Russian gas. We won't use Russian gas anymore. So it's going to be challenging, and it definitely adds to the risk picture. And yes, so how long prices will remain elevated as long as we manage to replace Russian gas, or European Commission finds a way to just somehow regulate this or control this price price rise, but caps are never good from the economist's point of view. And also, there are other implications for higher energy prices. If they stay high for longer, we have stickier inflation, which means bigger hit to purchasing power. We have production cuts, because it's not economically justified to produce anymore, it's too expensive. And we also have risks to competitiveness. So here you can see where the Baltics, Estonia, Latvia, Lithuania stand with respect to wholesale electricity prices. And we see that they're higher than they are in the Nordics. They're higher than they are in Poland. Yes, France and Germany, they're doing worse. But we're competing with this part as well, so quite a lot actually. So it's also a competitiveness issue, especially if the wage growth keeps as rapid as it is now. And overall, the effects, basically, I mentioned already. This is a bit longer list, but we could see a bit looser labor market. We could see also worsening government finances, apart from what was already mentioned. There are some positive effects as well. If we need this, if we want to find the silver lining, there is one. We are moving faster to renewable life. So not life, but way of living, which is good for the planet, of course, but maybe with a few steps back before going forward. And to summarize, so this gas sufficiency in the region, it's not guaranteed, but it's likely. There's a big question what happens in wider Europe, because we are small and open economies and we trade a lot. So if Germany is closing their production units, we are going to feel that. It still doesn't look like a very deep and massive crisis, but there are downward risks, definitely. So consumption is falling. We still need to see how the winter is going to look like. Current infrastructure likely insufficient, but we have new capacities coming up that should solve most of the regional supply issues. We can't rule out all the internal bottlenecks, but we should be more wary about LNG shortages globally. And finally, the prices are the more pressing issue currently than the amount. Yeah, so that's, I'll stop here.
Mm-hmm. Thank you, Agnieszka. So, to summarize this, the situation in Baltic countries, unlike was expected half a year ago, is not as dramatic. Even though we are closer to Russia and used to be very reliant on Russia and supplies from Russia, we also were quite wary of the risks related to these supplies. So we have LNG terminal in Klaipėda. We have alternative supplies. And the good thing that demand destruction, in this case, demand for natural gas, is also helping, and it has not been very harmful. Of course, shutting down one of the biggest factories for half a year is not a great long-term solution, but it is a solution for now. And when I think about the Baltic countries, and I also think that indirect effects will be very relevant from what we have seen from Agnieszka's presentation. Germany is the country that will have to cut down energy consumption most dramatically. And it's not just shutting down one company for a few months, and that will have ripple effects throughout Europe. And just to reiterate what Agnieszka has said, this is a very important issue which is not being touched upon now, because we like to think about the upcoming winter. The next winter, do we have enough gas in storage? Do we have enough LNG terminals? But we forget that storage capacity are filled with Russian gas, which is in all likelihood will not be available next year. And LNG terminals will not be sufficient. Liquefaction capacity will not be sufficient, even in the most optimistic scenarios. So that is why I share Matthias's cautious pessimism in this case, that energy crisis cannot be resolved very quickly. But we have to be optimistic here. And what is happening at the same time is we've seen massive investments in renewable energy, in new infrastructure, something that will take time to be visible, but this speeds up the transition, European transition towards renewable energy. I just saw a message from my school where my kids are going, is that the school is building a solar park. Something that they probably would not have considered a few years ago. But not only now manufacturing companies that rely a lot on electricity, on energy inputs, but also all sorts of companies, they no longer want to rely only on the supply that will come from the market. So good things will come in a medium term. In a short term, we also have other challenges. And the energy crisis that Europe is experiencing is not only related to Russia and the cutoff of energy from Russia. It is also related to a very, very extreme weather. And on that, we have a very good presentation from my colleague in Lithuania, Greta. So please tell us what is happening with the extreme weather and what are the costs there.
So hello, everyone. I'm sorry in advance because I will not be too optimistic about extreme weather as well. So my name is Greta. I work as an economist at Swedbank, Lithuania. For almost 4 years, I have been studying climate change and its impact on our economies. And probably what still shocks me the most, that climate change is still sometimes perceived as an opinion. I believe in climate change, I don't believe in climate change. So I hope that after this summer, which was heavy of examples of what a warming climate might look like, even skeptics are shifting to the opinion that we must adapt as soon as possible, as well as to better understand how it affects us, our societies, and our economies. European Union Research Institute says that this summer drought was worse in 500 years. And with all its consequences, devastating wildfires, sinking rivers, as well as damaged crops. And this summer also showed that climate change and extreme weather events might cause some unlikely problems, as we had in France. And at the beginning of this energy crisis, France was standing as a leader with all its nuclear power plants. Russia's energy resources were not too important. Yet, due to some maintenance works, as well as prolonged heat waves when temperatures reached more than 40 degrees Celsius, rivers become too hot to cool the plants. So as a result, French energy supplier was forced to reduce the output in nuclear power plants. And as you can see in this graph, that's actually inland electricity production has dropped to record lows. So prices, as shown in the previous graphs of previous presentations, has skyrocketed to record highs. A little bit different situation, but having also unlikely problems was in Germany. The Rhine River, which is longest, one of the longest in Germany, reached record lows this summer. So vessels that transport commodities, diesel, goods, were not able to reach industrial towns in Germany. And as you can see in this picture, massive sandbars breach its midsection, meaning that vessels like having hard times to reach the other cities. Vast examples can be found in the Americas as well. For example, Lake Mead drought is so bad that you can actually see it from space. And the American West is still currently facing its most severe drought in human history. And research suggests that conditions are drier now than they have been for around 1,200 years. And Lake Mead is a very important reservoir in the United States, which divides and allocates Colorado River. And Colorado River provides water for around 40 million of people in the United States, in Mexico. It supports dozens of indigenous tribes, 11 national parks, and irrigates 6 million of acres of farmland. So photos reveal that from space that actually the lake has changed a lot since the beginning of the century, and it is losing water quite fast. A dramatically and equally dramatic drought has also happened in China. What has Glenn also mentioned in his presentation, that actually this drought was so severe that even led to power rationing. And mainly because the drought caused rivers that feed hydroelectrical plants to dry up. So authorities were forced to include power rationing. And for some time, for around 2 weeks, companies were also forced to halt their production. Such companies, international companies such as Toyota, Tesla, they were also very severely affected by this rationing. Nowhere else, however, has suffered the extremes of Pakistan, which has gone from extreme temperatures of 50 degrees Celsius to devastating floods in only a few months, when the country is also facing financial and political crisis. Around 1/3 of Pakistan territory is submerged by flooding, and it required huge losses, both human and economic. Some early estimates point to around $10 billion of losses. So this example, I would say that it is quite a devastating illustration of how important climate adaptation is to us and our future. And what I've mentioned with these examples, these are like our reality now, and the number of extreme weather events is growing. And as you can see in this graph, it is accelerating every year. And especially such extreme weather events as floods, heat waves, and scientists point that the likelihood of heavy rainfall increased from 2 to 9 times. And the reason is very simple, because we have a hotter climate, so there is more moisture in the air. As a result, we have like huge and sudden rainfalls as well as floods. There is a number of studies that employ various simulation in regards to change in global surface temperature. And as you can see, also this yellow line shows how much our temperature would change if we include only natural factors, meaning that solar, volcanic eruptions do not have a significant impact on changes or our global surface temperature. And what happens when you include human factors? So when human factors are included, then temperature increases and goes hand in hand with the real observed temperature in the globe. And there are some theories that, for example, CO2 emissions and changes in CO2 emissions represent some natural Earth cycles, and fluctuations in CO2 emissions are quite normal. And in part that's true. As you can see in this graph, there have been several cycles, and yet ice cores provide unique contributions to the reconstruction of past climate CO2. That's probably the longest timeline I've ever saw in my economist career. And so you can see 800,000 years of timeline. So based on air bubbles trapped in mile-thick ice cores during the ice age cycles of the past million years. So you can see that atmospheric CO2 emissions never exceeded 300 parts per million, and they're standing now around here, and which means it has increased by around 50%. Despite various pledges, various climate agreements, CO2 emissions are rising further. We had seen a little drop during the pandemic, obviously, because part of our economies were shut down, but we're back on track. And data indicates that this year we will reach a new record of CO2 emissions. And together with growing CO2 emissions, together with growing extreme weather events, direct global costs of these extreme weather events are also rising, obviously. And since the 1980s, it is rising quite much. And in 2017, it reached more than $300. And when you look to the trend line of global GDP, you can also see that it goes upwards. So we can also expect it to rise in the future. And direct tangible costs, that is a direct effect of extreme weather events, such as damage to infrastructure, crops, livestock, affect various sectors. And what we have seen in France, in Germany, for example, even manufacturing can be affected. And biggest risks come through indirect and spillover effects. So we might have some disruptions in our supply chain. Quite directly is affecting agricultural sector, of course, and increase in floods or droughts will have a negative impact in agriculture, as we know. We have damaged crops, we have maybe lower supply of food, and so increase in prices. Yet there is one positive effect which might be felt for our societies, is that climate can also have some positive effects. For example, increased growing season in the Nordic countries. I also read that in Sweden you have more and more winemakers in the country. So this might be some positive effects, but I would say that these positive effects are much smaller than there are negative effects, as well as for insurance and finance. So we believe that more investments can be headed to Nordic and Baltic countries because there is a stable climate, more stable climate when we compare to, for example, Spain or other South European countries. At the same time, it might be too difficult or might be more difficult for you to get an insurance. For example, if you have agricultural business, it means that it might be more expensive. And some insurers might, they will reject your applications because the risk is too high. So there might be many implications for various sectors. Yet I would say that extreme weather events negatively affect Baltic countries quite differently because of the different structure of our economies. For example, agricultural sector is affected the most and can be affected the most. And as you can see, for example, in Latvia, when compared to other Baltic and Nordic countries, the agricultural sector is the most important and comprises around 4% of GDP when compared, for example, with Denmark. Yet I have recently worked with ECB's climate stress test, and it was very interesting to look and to see how ECB is performing these stress tests. And I can tell you that they're taking this very seriously, and we had lots of work to do. And ECB also says that around 30% of all firms in different sectors are subject to climate risk. So it means that around one third companies will be affected in one way or another. So how it affects us in the Baltics directly, and our calculations show that every resident in Latvia, for example, paid around 200 euros since 1980s just for direct climate effects. In Lithuania, it stands at around 300 euros, so it means a lot. And if you look to the average losses due to extreme weather events, so you can also see that these costs differ across countries. And I would say in the Baltics, we suffered the least in comparison to the Nordics or the Euro area average. But still, these are considerable costs, and we should take into account when we look and assess our future possibilities. When talking about extreme weather events, we usually take into account direct damage, which is damaged crops, which is damaged buildings maybe. But there are also many other costs, and what we have seen in France, in Germany, these are, for example, indirect tangible costs. When your, for example, supply chain is disrupted, when your productivity is also affected. Imagine during the heat waves, for example, people in the construction sector, they might not be able to work because temperature is too high, or their productivity will drop. We also see some diminished living conditions or even changed investor sentiment in these areas or these countries where extreme weather events are very severe. So investors might just not want to invest because the risks are also very high. But we should also think about intangible costs that are felt by the society or companies, but are difficult to measure monetarily. Examples include, for example, health, well-being effects. If you're having very severe heat wave or floods, in general, your life quality is diminished, and your life satisfaction might also be affected. But we also should not forget risk mitigation costs. Buying air conditioners, building stronger buildings, or investing into infrastructure seems like normal, but it's investing in changing climate. I mean, we're eating maybe more ice cream during the heat waves, so we're trying to cope with these effects. And we should also not forget that there are more costs. And once we include these costs to our calculations, and actually economic studies suggest that indirect costs could be an addition multiplier of direct costs ranging from almost 2 to over 10 times. And we took the lower bound of these studies, and we took 2 times multiplier. So yearly losses stand at around 100 million in Lithuania, and around 50 million per year in Latvia. And we expect that these average losses are to double by 2040. So you can also see that Nordic countries will be affected even more. And Estonia will be affected the least by the climate change. This summer sets a dramatic tone for the upcoming COP27 meeting, which will be held in Egypt this November, with long-awaited discussions on who bears the blame for these extreme weather events, and more importantly, who will finance the costs we are suffering. So, thank you.
Thank you. When it comes to climate change, the predictions about the damages and costs, both direct and indirect, based on simulations, may look mild, but we can see the examples like this year. I think when all of the estimates are made about the losses in Pakistan, the manufacturing stopped in China, insufficient electricity production in France, droughts in Rhine River, inability to pass for the transportation vessels. I mean, this may be another record, and we will see many more records. As Greta has illustrated, unmistakable trend of ever more frequent extreme weather events. We live in a very mild, boring region in that respect. In a good way, boring. I mean, we like to complain about the rain, long winter, not so hot in summer. Those 2 weeks when it's above 30, when we also complain because it's so hot. But when you compare to these events that we have seen this year, and not only in places like that are far away, like, okay, floods in Pakistan, but Germany, France. We already forgot the fires that we saw 2 years ago in Greece. Half of the country is fighting the fires. So these events will become much more frequent, much more damaging, and affecting many more sectors. So we have to, of course, keep an eye on them and also incorporate in our decision making. And finally, now that we know a little bit more on the environment that we live in, last but not least, I would like to invite Tonu, a chief economist in Estonia, who will overview what is happening in Baltic economies, how we are coping in this very difficult, stressful environment, and what do we expect going forward. Tonu, please.
We have heard today the gloomy picture about the world, rising interest rates, increasing prices. So it certainly will impact the Baltic countries as well. And I think that we all perceive it, we all have seen it, we all have read it. So I explain you what has happened and what is our short-term outlook for the Baltic countries. So if you look at these two graphs, you see that the GDP growth in the Baltic countries has slowed down. In the first half of the year, the GDP actually increased very robustly, especially in the first quarter, but it has slowed down, especially in Estonia. Certainly, I have some questions about the Estonian figure in the second quarter, but this is not today to discuss it. But we will forecast much worse second half of the year. And there is also GDP tracker made by OECD. And the last figure about this tracker is about August. And you see here that this curve is sloping downwards, which means that in the third quarter the picture has deteriorated in the Baltic countries. Now, regarding sentiment, this is economic sentiment, which is like a weighted average of the sector's confidence. You see here that the sentiment has worsened, which means that enterprises, consumers perceive that the outlook in the near future, the current situation is worse. And based on this, we also can expect that the second half and the next year will be worse than we had before. Now, when we put together all our forecast, what we have made about different countries, and then when we weight these countries, these forecasts with our export structure, then we get like a proxy picture about foreign demand. And here you see that the foreign demand was especially strong in 2021 last year. It has slowed down this year, and next year, as we forecast, very substantial slowdown and even contraction, as we spoke about Germany, for example, especially, and also Russia, although Russia is not a very large share in our exports, then in principle we can project that next year the foreign demand, the average foreign demand for the Baltic countries will slow to zero or even contract. And therefore, based on this figure, we can say that next year the export opportunities will be much worse than we had before. When we draw our projections longer for the 2024, in principle, yes, this is over the next year, then we see that the foreign demand is expected to improve somewhat. Now, regarding Russia, certainly when we look back to 10 years, then the share of Russia in our trade, in the Baltic countries' trade, both in export as well as in import, has reduced. And especially this contraction has been this year. When we take the share of Russia in our exports, then probably the share in our local export hasn't dropped so much. But when we compare with last year, then certainly export to Russia has contracted substantially. And now, especially if you look at Lithuania, then in Lithuania, both exports and imports have reduced to Russia. And this is in nominal terms, because you have to remind that prices have increased. When we took this picture in volumes, then the picture would have been even worse. I mean, in that sense that the contraction to Russia can be even larger. Now, regarding Coming to the real economy, looking at what has happened with manufacturing and what could be the short-term outlook for the manufacturing sector. First of all, if you compare now Latvia, Estonia, and Lithuania, then you see that Latvia and Lithuania has done a bit better than Estonia, but still the curve is sloping downwards. And when we compare also what are the export orders for the manufacturing, then you see that these export orders are worsening gradually, and we can expect that in the second half and next year the export orders will be worse, which enables us to export less as well. Now, just to take a general picture about the GDP, we have forecasted close to 0% of GDP growth next year, which means that the situation will substantially deteriorate. And if you now look the left side graph, this is now where how GDP levels in constant prices have changed during the past several years, and you see here that in Estonia and Lithuania, the recovery from the 2020 corona crisis has been substantially stronger than it was in Latvia. Now, going to the prices. Producer prices and import prices. If you compare now the Baltic countries compared to the European prices, then you see that in the Baltic countries, so far up to the last year, there wasn't much difference regarding the producer prices. And now this year, unfortunately, producer prices are increasing a bit more than in Europe in general. And if you compare also manufacturing import prices, not very big difference. But in principle, what this story about the producer prices means is that when our producer prices will start to increase considerably faster, then it means that we can also think about competitiveness, how we are doing in front of our European trade partners. Now, if we look at the Baltic countries' export shares in euro area, then you see that the export shares actually increased in past years, and especially the increase of the market share in euro area was fast in corona years, in the pandemic years. But now, since last year, there has been a change in Estonia and Lithuania, but not so in Latvia, which means that, and based on this picture, we can in principle draw a thinking or draw a conclusion as well that it can also speak about our competitiveness. These actually have to be analyzed more deeper because there can be also some export structural issues, but in principle we can say that the competitiveness of the Baltic countries' enterprises is at risk now. Now, going to the consumer prices, if Yes, I think we all know that energy prices are the largest share of consumer prices. For example, in Estonia, 42% of the CPI comes from the energy component. In Latvia, in Lithuania, the share is actually some 10 percentage points less than in Estonia. And now if you compare also the price increase without energy component, then you see that that part of the price has also increased, which means that inflation has become much more broad-based, I mean, without energy component. And also, if we compare consumer prices compared to the EU inflation, then certainly in our countries, in the Baltic countries, the inflation has increased much faster, and it's already above the 20%, in Estonia 25% already. Now, what about purchasing power? Labor shortage is severe still. Not only in the Baltic countries, but this is also the issue in many other countries as well. Wages are increasing very robustly in nominal terms. GDP growth is in nominal terms also increasing very strongly. But when we look at purchasing power, or when we look at wages in wage growth in real terms, when we adjust it with inflation, then you see that in this year, real wages or the purchasing power contracts quite substantially. Next year and 2024, it will start to recover, but based on our calculations, it will not recover to the level what we had 2024 during our forecast period. So it means that it takes time. Regarding the inflation, we already have heard about that we expect that inflation is expected to slow, and this will be the case also in the Baltic countries as well. This year, we see that inflation peaks to the very high level, 17 to even more than 20%. We expect in Estonia that inflation can be even more than 20% in average. And but it will peak soon, and then next year we will expect considerably smaller growth of inflation. Now, how about when the purchasing power contracts? What about consumption? Here you see that consumer confidence has deteriorated substantially, and also retail sales, which have been strong for a while, also have fallen. So this means that in principle we can say that consumers are suffering the higher prices. But there is also buffers for households, and especially the buffers are related with deposits or savings, which have increased especially strongly during the corona period. If you look at these graphs for all the Baltic countries, I've drawn the yellow line, which is like a trend of the growth of the pre-pandemic years, 2015 to 2019. And now you see here that when the corona crisis started in 2020, then households' deposits started to exceed these trends step by step even more. Now, in principle, now we can say that the deposit growth has substantially decelerated, but it still is growing, which means that the excess, we can call it excess deposits, are still very strong, and these are like buffers for, and also they can also hide some pent-up demand. But there is an issue with it, because these deposits are very unevenly distributed. And when we add also Estonian case, in addition to these deposits in Estonia, last year households could withdraw quite substantial money from their pension fund, the second pillar pension fund, or a mandatory pension fund, what was it called, 1 billion euros this year, 300 million euros. And this is like a continuing issue, actually, because households can withdraw money next year as well. And this also gives some extra money for consumption as well, and for investment, certainly. And here you see the graph also, how these household deposits, deposit growth has decelerated, but still it is growing. And as the purchasing power is deteriorating, then we expect that next year we will see considerably weak private consumption growth compared to what we had last year and what we had this year. And to summarize, first, foreign demand will deteriorate. Economic outlook has become worse, and we can see a mild recession in principle this winter. And probably even in Estonia we can see this autumn. Enterprises' competitiveness is at risk. Inflation is expected to ease next year. And the recovery of purchasing power takes years, which also affects consumption. Thank you.
Thank you, Tono. Please stay for a moment. I have a few questions for you. Also from the audience online, but also here, if you have a question, feel free. We have a hand. No, it's... somebody will have a question there. But for now, the conclusions not very optimistic, but maybe the good part about them is that the recession is going to be mild. Mild means not so bad, a few quarters of slightly contracting GDP. That does not lead to large increase of unemployment. The main question, I think, for clients, for us, is when we see this extreme environment, interest rates, inflation, geopolitics, electricity crisis, energy crisis in general, why are we not afraid of a deeper crisis, something what we have seen in 2008, 2009? Is there something different that prevents from something happening, something like that?
We draw our projections based on foreign demand. So certainly there are certain local issues as well. But when we compare how are doing our trade partners, then this allows us not to be very pessimistic. This is one case. Now, when we come to the demand side in the Baltics, then as we see that we have still buffers. Certainly these buffers are not very evenly distributed, but still the demand side so far has been relatively strong. So when we now go to the next year, then I still think that we have to reference our projection based on our trade partner, how our trade partners and the world is doing, as we forecast that that there will be not very deep and very robust contraction of the economy. Then, in principle, that could have the specific impact to the Baltic countries as well. So, if we can see that our trade partners are doing worse, when inflation will be more sticky and will stay higher, and then our consumption will suffer more when real estate prices then start to contract, then we can talk we can talk different pictures.
Okay, let's take the question from the audience first, and then we'll continue.
Yes, I wanted to ask, do economists in their forecasts even consider that supply of Russian gas or gas-related products as fertilizers will be renewed in shorter or longer terms?
Yes, the answer is no. We don't think that this is likely to happen in a forecastable horizon, 2023, 24. Regardless, of course, it's very difficult to forecast how the war will evolve and how Kremlin will behave, but I hardly can see a scenario in which Europe will turn and say, okay, let's be friends again. That's not going to happen in a foreseeable horizon. So now all of the forecasts and all of the actions by businesses and governments are making assumption that we are done trading with Russia in all goods and services and all energy. So that's why Agnieszka and we were saying that next year is going to be challenging because this year we filled up the reserves with Russian gas. Next year we have to fill up the reserves with something else or replace very quickly the energy composition mixture, which is not easy. And getting back to the Baltic countries, of course, I mean, Baltic countries are one of the most open countries in the world, and our economic developments depend on not our consumer confidence on how much they're willing to consume. That's vice versa. Our competitive position, our ability to export to other countries will determine how confident are consumers, what is happening in the labor market, do we see more jobs, higher wages, and so on. So naturally, if Germany sees the recession not of contracting 1-2%, but has to drop by 6%, which can still happen if it needs to ration the gas consumption by 20%, then it would have a deeper negative consequences. But I would still answer my own question that 2008 and 2009 scenario is still extremely unlikely due to many factors. In 2007, 2008, we had a massive trade deficit of, not in Estonia, but in Lithuania. In Lithuania and Latvia, 15 to 20% of GDP. Our economies were overheating much more than US economy is overheating now. We were consuming and importing a lot more goods than we were able to export. This is not the case. Up until the energy crisis, we had a balanced trade and current account. And I think one of the most important things is something that we couldn't do in 2009 is to apply the counter-cyclical fiscal policy. The economy was dropping, the consumption was dropping, investments were contracting, nobody was buying real estate, and at the same time, governments, you remember very well here in Latvia, but also in Lithuania, to some extent in Estonia, had to increase taxes, to cut social spending, to cut public investments, something that you shouldn't do in a deep recession, but we didn't have money. Lithuania was borrowing at 11%. Annual interest. Latvia at some point couldn't borrow anymore, so had to resort to international institutions. This time is different in that respect. Being Euro area member countries, we still can borrow at reasonably low interest rates, much cheaper than Italy borrows. So that should tell you something. All three Baltic countries are borrowing cheaper than Italy. So that tells you something how the investors are viewing us, right?
Yeah, and when we compare also household saving rates, then before 2009, household saving rates were in very deep deficit. In all Baltic countries now, we are on a very strong positive side.
So if we have a few more questions, one of them is a bit yeah, okay, let's go.
I will just come back to this energy thing. Do you see that some part of the natural gas shortage could be substituted by oil products like diesel and so on? And maybe that's a solution for next year.
It depends from case to case. You can comment the Estonian example, shale oil usage.
Yes, actually in Estonia we already are increasing the shale oil share, and when we take, for example, the issue of natural gas, then in Estonia, as Agnieszka already showed, the share of natural gas in Estonia has reduced. It's not very large, and in principle, we can't say probably, when we talk about the peaks, then at least up to now, we see that there can be issues to cover the energy peaks in Estonia. But in general, we can substitute quite large part of our local energy production. So, but there can be issues with the peaks. But when we talk about gas availability for this winter and until the next spring, then all gas suppliers have said that in principle they can serve their clients in Estonia.
We have, I mean, that's the case in many countries. In Vilnius municipality, Vilnius is very reliant on natural gas for heating, and we're going to replace that this winter with the stuff that I don't remember, how is it called in English? Fuel oil, which is much more pollutant, dirty, but cheaper. So there's a short-term solution. It needs some investments. You need to build the rail tracks. It pollutes the environment more. But I mean, you can survive. So in many cases, there are these short-term dirty substitutes. Another technical question, maybe Agnieszka will help to answer this. And Newton, I don't know if you know the example from Estonia, but I understand that this is a very relevant issue for many businesses who have fixed prices for electricity. Longer-term contracts for 1-2 years, and the question is, are we going to see the terminations of these contracts? What is the situation there? And because in Lithuania we had one example when one company has signed these long-term contracts at a reasonably, not reasonably, but attractively low prices, and then at the end of the summer said, sorry guys, we can't supply that. So it's now going bankrupt, and so on and so on. So the question, I guess, is how likely that we will see more of these cases when energy and electricity suppliers will not be able to fulfill their commitments. And I think that the simple answer here is it depends on who is selling that energy. If that company is producing the electricity, it has the renewable energy plants with a very low marginal cost, and even if they are selling that for 30 or 20 euros per megawatt hours, they can still produce it at a lower price. They're forfeiting their profit that they could get by selling the electricity in an open market, but there's no risk that they cannot supply it. In similar cases, even if the seller of the electricity is not producing the electricity itself, if it has hedged itself by buying the electricity in long-term contracts from other producers, then there's no risk. But my guess is that some of these contracts will be terminated, and we will saw some cases in Lithuania when large producer also no longer honors these contracts, but there's always or very often a clause when a supplier of the electricity can terminate that contract. So I guess one has to read the contract, but I suspect that these very low prices, even if you have a signed long-term agreement, it is not a given reality. Is that the case? Yeah.
I pretty much agree with you, what you already told.
When I take the Estonian case, then it very much depends on what kind of policy the government will offer for enterprises, because currently the government has worked out the energy compensation like a universal service for households, which means that the major electricity producer, Eesti Energia, has been asked, I mean, this is like government enterprise, has asked to produce electricity with a price which is agreed by the competition authority. So, and this is offered for households, and but households can also choose the other electricity price as well, when they compare this universal service price. Now the government is also working out or thinking about how to compensate enterprises. But the issue actually very much depends on what kind of solution European Commission will submit. And another issue is also that substituting of enterprises is different for small enterprises and large-scale enterprises. If we are talking about large enterprises and we substitute it, or we offer some substituted price, then it can get permission from the European Commission.
We have two more questions from the audience online. Related questions, and I'll ask one of them. I'll give you to you, Matthias, because you touched upon that already during the first half of this Swedbank Economic Forum, and it's the question that has been bothering central banks and economists and businesses for the past 1.5 years. Is inflation transitory? And is it possible that in a couple of years we will again see a very low inflation, a risk of deflation, and return to a zero interest rate environment? You touched upon this a bit, but let's elaborate a little bit more. Do we have a microphone here? Yes.
Yeah, I think that's a very good question, and I'm actually thinking about that because I need to respond to some journalists back home about the Riksbank. So I think I'm quite critical about some of the monetary policy I've seen around the globe, also from the Riksbank. And I'm actually thinking how to communicate that in Swedish. I think inflation will come down, but inflation will not come down to below 2%, which is the target for most central banks. I think looking forward, and I think you touched upon it as well in your presentation, and also when you talked about energy in Europe. So this year, we will survive with Russian gas. We will invest heavily into new energy sources in Europe. For me, all of that means prices up. Firms are moving back to Sweden, to Scandinavia, to the Baltics, to Europe. For me, that means costs up, because cost of living and wages are higher. So I think, when I think about what is the new equilibrium, maybe 10 years to come, I think policy rates will be higher. And I think inflation will be higher. That doesn't need to be a problem, because I think that's good. Because what I think is a problem is QE and negative rates. It creates the wrong incentives and inflates asset prices rather than real economic activity. So I think higher, and I'm not concerned about that. Let's say 3% on average inflation, because we have so much to do. And I agree with Nereus that we will invest a lot in renewable energy. We need to do that. But it will take time. We can't do that in a year, which means that energy costs will be high next year as well. Regardless of what we do, we can't solve the energy crisis in 1 year. And if we were to try that, commodity prices would go up, again, kicking inflation up. So I'm a bit optimistic about extreme weather, even if it was a pessimistic presentation. To then answer the question, policy rates will stay higher than we have seen. Negative rates, I don't think we will have for a long time. And to just give you a flavor, we will have 2 new members of the executive board in Sweden. And I know both of them. And both of them were skeptical about QE and skeptical about negative rates. And I think that's good that we get 2 new members in the executive board.
In the Riksbank, yes?
In the Riksbank, yes.
So I'll just add something to that. If you think about, hedging the interest rates for 5-10 years ahead, there are 2 global trends that will keep inflation higher and interest rates higher. One is global population is aging more rapidly. That is inflationary, because savings are being used up. And there will not be as much excess savings. That's something that we have seen during the last decade. Even China is aging now. Working age population is shrinking. And another factor is the deglobalization trends. Something that has started with the Trump era, but is visible across many governments, has intensified, I would say, during the pandemic. many people were, and many countries were surprised that, for example, 90% of antibiotics consumed globally are produced in one province in China. That's convenient, cheap, but it's a bit risky. And that's the case with many things. And what we have lived in is just-in-time production. We had decades of just-in-time production and moving where it's cheapest, most efficient. I think this is reversing. And now it's not just in time, but just in case. Produce a bit more expensive, but closer to home. And that's maybe a good thing for us. We will see a lot of manufacturing companies moving at least part of their activities closer to home. We've seen that in Japan, we are seeing that in US, we'll see that in Europe. So that's not necessarily a bad thing, but that will mean that the things will be more reliable, they will be closer to home, but more expensive. So higher inflation, higher interest rates.
Yeah, but if I, I mean, if I would discuss a bit it, because I would ask whether European and US enterprises would choose high cost and less competitiveness compared to their Asian competitors. I mean, when they shift their production to closer to the markets. That can be also the question what we have to solve, because, I mean, for example, it's, yeah, in theory, it can be so, but when the shift can be very massive, from bringing production closer to the higher costs, then it means that we will become less competitive compared to China, compared to those countries which use that supply chain, which are in Asia.
I think that's a good point, but I think, and that's something we haven't discussed today, and that's geopolitical situation. So some of you might be aware that Germany will change their policy towards China. And I think many countries in Europe has woken up, being too reliant on Russia, and looked at their own kind of business and policies, what they are too reliant on. And all of us are reliant on China. So according to news, at least, Germany will do a complete rethink of reliance on China. And also, we have a more acute situation, which is Taiwan and China conflict. There is nobody who would gain out of a military conflict. But according, again, to media and Bloomberg, Biden is thinking about imposing sanctions on China. Now, China is a completely different game than Russia. And also, according to what's happening in the geopolitical, also EU is at least thinking about sanctions on Russia. So I think, you're right, Turner, but I think all the corporates I meet in Sweden are seriously thinking, and are actually moving back production. And we can see that in the commercial real estate space, for example, where old industrial buildings are still in high demand. Stock to warehouses are much more used in Sweden. We can see the level of stocks in corporates are already increasing. So I think we will see a change, but it's not the end of globalization, because we need globalization. Just a bit, I think we'll see a bit less of it.
Because the issue is not bringing one company or two companies. Because this company, what was in Vietnam or what was in China, that was surrounded by a very large net of other supply chain. So that is also a complicated issue. I just raised the question, not, yeah.
Thank you, Tonu. Thank you, Matthias. We have tons of more questions, but I have to moderate this. If you put 3 economists on the stage, they'll never leave. And yes, but, and then this will continue. I will answer just a few more questions very briefly. One is extremely good. Are we at the peak pessimism? We're close to peak inflation, but probably not close to peak pessimism. The peak pessimism will be in winter, we need to see that we are managing through without blackouts, without having to stop many manufacturing companies. The energy shock and energy shift is so large that it's very difficult to model and predict. As you saw from Agnes's presentation, most likely scenario that it's going to be fine, but there are extreme outliers that can still happen with uncomfortably high probability. So we are not at peak pessimism. You will see downward revisions in forecasts and more gloomy titles. But probably by the end of winter that the worst will be over, in terms of forecasts at least. Now, another good question which would require almost forever to answer, but I will try to touch very briefly upon it. It's a very good question. Are we getting, is there a setback in terms of sustainable development in energy? Yes, we see a lot of investments in wind power generation, in solar power, but at the same time, coal burning is at the record highs in Europe. Coal prices are surging because the demand for coal is so large. We are burning, I forgot again that, oil fuel, shale oil in Estonia, oil fuel in Lithuania, something that we never thought that we will do again. So this, in that respect, yes, it is a setback. We are burning a lot more of our polluting stuff, but only for the short period to bridge this. This is for the transition. I don't expect increase in the coal usage in Europe during the next 2-3 years. So this is a sad setback, but it is necessary to decouple from Russian energy markets. At the same time, I should repeat myself, the investments in renewable energy is very encouraging and has been pushed forward by this crisis. And the final question is, again, what does this high inflation environment in the future mean for asset prices, Kjetil? Remember, asset prices. So I will answer this very briefly, and then I will ask you to answer this even briefer. Of course, high inflation means higher discount rates, higher interest rates and higher discount rates. And any asset that will produce cash flows in a distant future becomes less valuable today because you discount future cash flows at a higher discount rate. So all of the growth companies in US, you've seen Peloton and you've seen others, something that have not been profitable but were expected to be profitable in 10 years. Their price has dropped by 90%. So still those companies, growth companies that need cheap capital, that are very reliant on cheap borrowing, they will suffer the most. If you have a company that has a pricing power, they will not do very bad in an inflation environment, especially if large part of the costs are fixed. If you think about the real estate, usually real estate does not do very well in a high interest rate environment. So some adjustment is possible or maybe even likely. If you have something to add, you may, but I have a question, Kjetil, before you find the microphone. If you were given a yes or no chance to answer, you have to put all of your investments in US equities or European equities. Which would it be?
Was that a yes or no? Yes, but.
Europe. You can choose Europe or US.
If you look at pricing, US is still higher priced. Yeah. And it all, sorry, this is going to be a long answer regardless. If you look at the period of time now with higher interest rates, I would say that the cyclical sector of European economy is more favorable.
I think that
less leveraged.
Yeah. I agree on that with you.
And also the short answer is stay as far away from the consumer as you can get. More pricing power.
Okay, that was a short answer. Thank you.
Did my best.
Okay, it's nice that questions started pouring in, but a bit late. Those who are here, thank you for coming, and I think we can still have a fruitful discussion with a cup of coffee. Those who have observed us online, also thanks for joining us. And please join us on the 10th annual Swedbank Economic Forum in 1 year. And I think, I hope already then we will certainly be past the peak pessimism, and we will have good, much more optimistic presentations looking into a much more brighter future. Thanks again. Thanks for inviting us. See you back next year.